Let's take a look at the second part of analyzing transactions and looking at how they fit into the accounting equation. We talked before about assets and liabilities, and the only owner's equity we talked about was the capital account when the owner invests money into the business. But the owner's equity section is all about the amount which the business assets exceed the business liabilities, the amount of claim the owner has on the business assets. So the owner puts money into the business. The owner has a claim to be able to take that money out of the business. Now the business has to first pay off any creditors, and whatever is left over is there for the owner. This leftover is also called net worth or capital. Let's take a look at an example. If the business has a total assets of $100,000 and total liabilities of $60,000, what is the net worth? What is the owner's equity? We use our formula of assets minus liabilities equals the owner's equity. So we have 100,000 minus 60,000 equals 40,000. So this is our accounting equation. In the previous slide, we took a look at assets minus the liabilities. However, we can rearrange that to say assets equals liabilities plus owner's equity. And this is the preferable way, that it's equal to the other way, but it's preferable to put it this way because on the left side are all the assets, all the thing the company owns, and on the right side shows where the money comes from and who has claim to those. So if we don't pay off our loans, the creditors can come back and take the assets away. And whatever is left over of the assets after we pay off creditors, the owners can come and take them away. We have 3 questions. What happened? And again, this is what happened today. Not what's happening in the future, not what happened in the past. What's happening today? What are we giving up? And what are we receiving today? Then we're going to take a look at which accounts go with those things that happened. And we're going to use the chart of accounts to be able to answer question number 2. Then we have to classify these accounts as whether they're assets, liabilities, or owner's equity. We have question 3, in which we first determine if something has increased or decreased by going back up to question number 1 and asking, do we have more or less of each of those things? Then we make sure that the accounting equation is still in balance by putting our amounts under the A, L, and the E. Now, when we're dealing with owner's equity types of transactions, there's 4 types. All we've dealt with so far is owner investment. The owners can make investments, and that increases equity. But the owners can also take money out of the business, and that's an owner withdrawal, and that's going to reduce equity. Owners don't want to be the only ones to change equity, though. If you purchase a house and you have a mortgage against it, and you have to put some money in yourself, that money that you put in is equity into that house. But what you're hoping is that the house is going to go up in value. You'll be able to sell it, pay off that mortgage, and the rest is for you, which includes the amount that you originally put in, your original equity, plus the fact that the house has increased in value. That increases your profit that the house made for you itself. When you start a business, you want the business itself to increase your equity. Now it does that by revenues. Revenues are the kinds of accounts that are involved with selling things. So whenever the business sells services or products, we have revenues, and revenues increase our equity. The business also has expenses. This happens when the business uses things. So the business uses employees, that's wages expense. The business uses electricity, that's utilities expense. The business uses use of office space, that's rent expense. So whenever the business is using services or products, those are expenses, and they are going to decrease equity. Whenever we sell something, immediately you should think revenue. We're going to try to use the word sold as being our key word for revenue. Revenue is recognized when earned, even if cash has not yet been received. What this means is that if we mow the grass for Mrs. Smith and she's not going to pay us until next week, we actually earned the money today when we mowed the grass. So we're going to put that in our books as we sold our services, our mowing services, and that is revenue. We're going to record that revenue even though we haven't received the cash yet. And this revenue will increase owner's equity. Examples of revenue accounts include delivery fees and consulting fees. Now, notice that the word fees is here, and maybe you think of the word fees as being something you have to pay out, like parking fees and library fees and technology fees. But here, in accounting, that fees word is used to mean we're selling something. So delivery fees means we're selling delivery services to our customers. Consulting fees means we're offering consulting services to our customers. So it's fees that we're charging to our customers, not fees that we ourselves are paying. Rent revenue, if we rent out space, if we're a beauty salon and we rent out some of our space for someone that does nails and they pay us rent, then we have earned rent revenue. Interest revenue is if we have money in some kind of investment and that investment earns us interest. Sales is the account that we use when we're selling products. In other words, delivery fees, consulting fees, something with fees on it usually means we're selling a service. Sales is the word that we use when we're selling a product. Expenses represent the decrease in assets, and it happens when we use products, and it decreases owner's equity. Examples of expenses include rent expense. Now we talked about rent revenue when we sell the use of space. When we sell space to somebody else, we have rent revenue. Rent expense happens when we use space and we have to pay somebody else for it. Wages expense happens when we use the employees. We don't own the employees. If we don't pay them, they'll quit. Okay? When we use the employees, we have wages expense. Utilities expense happens when we use the electricity. Repairs and maintenance expense happens when we use use the facility and we have to repair it. Whenever we take a look back, once we're done with the month or the year, and if we have revenue is more than expenses, we have net income. So here's an example. Luke Perkins performed $6,000 of tax services this year. Okay, so he fills out tax returns for people, and he performed $6,000 of those services. And when he performs those services, he sells those services, that's revenue. And he incurred expenses of $1,500 for rent, $500 for telephone, and $3,000 in salaries that he paid to others. Take all our revenues, total them up, subtract out all the expenses, and that's going to equal whatever's left over is net income. If it's a positive number, it's net loss if it's a negative number. Here we have $6,000 in revenue from him selling his services. We have a total of $5,000 of expenses, which includes the rent expense, the telephone expense, and the salaries expense, all added together. And 6,000 minus 5,000 is a positive number of 1,000, so that is net income. If we would have had 7,000 of expenses, we would have had a negative 1,000, and that would be a net loss. And here it is. When expenses are more than revenue, it's a net loss. John Atwood performed 8,000 of delivery services this year and incurred expenses of $3,500 for rent, $500 for utilities, $3,000 for salaries, and $2,500 for gasoline. Again, we use the same formula. We have 8,000 of revenue, and we have a total of 9,500 of expenses. So now we have a negative number of 1,500, so that is a net loss. Withdrawals happen when the owner takes money out. Okay? So the owner is withdrawing cash or equipment to use for their own personal self. It reduces owner's equity. This is sometimes called withdrawals and sometimes called the drawing account. Let's take a look at some more transactions for Mary Adams. So here's a revenue example. Mary performed services and received $4,500 in cash. What did the business give up and what did the business receive? The business gave up time and effort to sell services. So we're going to say sold services, and the business received cash. Okay? So for the sell services, we need to look under Mary's chart of accounts under revenue, because whenever we sell something, it's a revenue. When we look under her chart of accounts under revenue, we see consulting fees. And for cash, we of course know that we're going to use the cash account. Consulting fees is revenue, and cash is an asset. Then we take a look at increase or decrease. We go back up to the beginning and say, do we have more or less cash? We have more cash than we did 5 minutes ago. Did we sell more or less services? We sold more services. So there's an increase in consulting fees and an increase in cash. When we take a look at our accounting equation, we have an increase of $4,500 in cash and an increase of $4,500 in consulting fees. What if Mary pays wages? What did the business give up? It gave up cash. What did it receive? It received the use of employees. We don't own the employees. We just got to use the employees. So as soon as we say that we use something, we know that means an expense. We look in the chart of accounts under expenses and we see something called wages expense. And we gave up cash, and of course we'll use cash for that. For increase or decrease, we go back to the top. The business has less cash because it paid it out. It has more use of the employees than it did 5 minutes ago. So we have an increase in wages and expense, a decrease in cash. However, if I said that I had an increase in an asset and a decrease in owner's equity, it would not balance. Okay, so I have one more step to do whenever I have owner's equity accounts. I have to go back to the chart where I said, does it increase or decrease owner's equity? Now, an increase in wages expense is going to decrease owner's equity. You may want to memorize that chart. So I have to change the increase of wages expense to a decrease in owner's equity. And now I have a minus 750 on the left side of the equation and a minus 750 on the right side of the equation. And it balances. Here's another example. This time Mary performed services on account, which means on credit, which means she did the work and she earned that $6,000, but the customer didn't have the money to give us today. We will receive the money in the future. Right now, today, the customers owe us. Customers owe the business. That's what we received. It's our money. We legally own that money. It's just in the customer's pocket right now. And we gave up selling our services. Okay, we sold services, so we're going to use the account called consulting fee. We did not receive cash in this thing. We received the fact that customers owe us. And when customers owe us, we use the account called accounts receivable because we're going to receive the money in the future. Consulting fees is a revenue account, and accounts receivable is an asset. When we look at increase or decrease, we go back to the beginning. We have more selling of services than we did 5 minutes ago, so that's an increase. The customer owed us more than they did 5 minutes ago, so there's an increase in accounts receivable itself. Now, when we go to the accounting equation, we have to remember that revenues and owner's equity accounts, we have to look at our chart before we put it on here, because even though we had an increase in consulting fees, it doesn't mean that that in turn increases owner's equity. Now, it so happens that revenues do increase owner's equity, so we're going to keep the plus 6,000, and we have plus 6,000 equals plus 6,000. Another example, we received $2,500 in cash for services performed in a previous transaction. So in other words, we already performed the services, but the customer owed us some money. Now we're receiving some of the money that the customers owed us from before. We're not doing services again. We already did the services. We already sold the services. Okay? We're just receiving some of the customers' money that they owed us from before. So we're receiving cash. What we're giving up is the fact that the customers now owe us less. We used to have a lot of money in the customer's pocket that we owned, even though we didn't have it in our own hand, we owned that money in the customer's pocket. Now we have more cash in our own hand, but we have less cash in the customer's pocket. That's what we're giving up, the fact that we now have less that the customers owe us. Okay, so we know what the business receiving and giving up. It's receiving cash, so we'll use cash as an account, and it's giving up the fact that the customers owe us less. Whenever customers owe us, we're going to use accounts receivable. Cash is an asset, accounts receivable is an asset. We go back up to the top. Do we have more or less cash than we did in 5 minutes ago? Well, we have more cash than we had. The customers, do they owe us more or less than 5 minutes ago? They owe us less than they did 5 minutes ago. So cash is an increase. Accounts receivable is a decrease. And both of these are on the asset side, so I have a plus 2,500 and a minus 2,500 on the asset side. So if you take any number and you subtract the exact same number, you're going to get 0. So I have 0 on the asset side, and I have nothing on the liability and owner equity side, and 0 equals 0.